Like the idea of being invested in a world-class compounder? Looking for double-digit dividend growth that's actually been accelerating even over the last few years? Interested in buying a super high-quality dividend growth stock while it's on sale? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is the world's largest industrial gases provider. Who thinks or worries about industrial gases on a day-to-day basis? Nobody, right? Well, not if you're a manufacturer of just about anything. See, industrial gases are low cost but critical input for the manufacturing processes of countless everyday items. So demand for industrial gases keeps on rising. Not only that, but this industry is run by a powerful global oligopoly. It's an ever larger pool of profit being divvied up between a few major players. That means more money for this company and lots of growing dividends for its shareholders. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Linde PLC, which appear to be trading at a significant discount today. Linde PLC, stock ticker LIN, is the world's largest industrial gases company. Founded in 1879, Linde is now a $156 billion by market cap gases giant that employs approximately 65,000 people. The company reports results across the following geographic business segments: Americas, 39% of fiscal year 2021 revenue, EMEA, Europe, Middle East, and Africa, 25%, APAC, Asia Pacific, 20%, Linde Engineering, 9%, and Global Other, 7%. I love this business model for three key reasons. First, industrial gases like nitrogen and hydrogen are critical input for the manufacturing processes of many different end products we all use every single day. Think various electronics, for example. Simply put, global manufacturing basically doesn't work without this input. That's another way of saying our modern day society ceases to exist without the gases. Second, since reliable access to a constant source of these gases is a process requirement, a manufacturer will set up a long-term contract with a dependable provider. A provider like Linde will then often install complex infrastructure on site in order to ensure regular access to industrial gases, which makes it almost impossible for a manufacturer to switch providers at a later date. Third, Linde is part of a global oligopoly. Only 3 major companies in the space control almost all of global market share. This is a dream setup, which is what perfectly positions Linde for continued growth across revenue, profit, and the dividend. To date, the company has increased its dividend for 29 consecutive years. Linde is a vaunted dividend aristocrat. The 10-year dividend growth rate is 7.8%, which is very good. Better yet, there has been a noticeable acceleration in dividend growth of late. For perspective on that, the most recent dividend raise came in at 10.4%. That kind of double-digit dividend growth is really what you want to see here, as the stock's lowest yield of 1.5% almost requires it. Good news on that front, the payout ratio is only 39.1% based on current fiscal year EPS guidance. With that, there's room for more low double-digit dividend growth over the foreseeable future. Now, the yield isn't super compelling for income seekers, even though it is basically right in line with its own 5-year average, but Linde is a world-class compounder that can and should churn out significant wealth and dividend income over time. For younger dividend growth investors who have a long-term vision, Linda offers a fantastic dividend package. Looking at business growth, Linda advanced its revenue from $11.2 billion in fiscal year 2012 to $30.8 billion in fiscal year 2021. That's a compound annual growth rate of 11.9%. This looks outstanding on the surface, but Linda merged with former rival Praxair in an all-stock transaction in late 2018. So a lot of this top-line growth wasn't totally organic. Earnings per share, on the other hand, grew from $5.61 to $10.69 adjusted over this period, which is a compound annual growth rate of 7.4%. That number does factor in the big jump in the outstanding share count starting in fiscal year 2019. The thing is, we also have to take the bottom line growth rate with a grain of salt. That's because we're looking at a blend of a pre-merger growth rate and a post-merger growth rate. The former was slower than the latter. An acceleration in EPS growth has been playing out, which is why we see the aforementioned acceleration in dividend growth. The company's most recent quarterly earnings report, which is Q3 fiscal year 2022, showed 14% year-over-year adjusted EPS growth, and the guidance in that report is calling for 12% to 13% year-over-year adjusted EPS growth for the full year. Looking forward, CFRA is forecasting that Linda will compound its earnings per share at an annual rate of 12% over the next 3 years. This is further evidence of that growth acceleration. Seeing as how this lines up pretty well with Linda's own projections, I'm inclined to strongly agree with CFRA's number. I think CFRA states it best with this, and I quote, "We expect Linda to continue to hike prices and drive volume growth, resulting in sales growth of nearly 11% in 2022 and high single digits in 2023. Approximately 65% of Linda's sales are from fixed fees or resilient end markets, and most of Linda's business has immediate cost pass-through clauses. A strong long-term growth outlook is supported by secular growth in electronics, healthcare, and clean energy," unquote. If that's not enough to make you giddy about investing in Linda, I'm not sure what will. But just in case the message isn't coming through, CFRA adds this, and I quote, "We think Linda is well positioned to benefit from rapid growth that we anticipate in clean energy markets. Linda already has several significant applications that reduce, capture, sequester, or clean and monetize gas streams for use, such as Linda's $1.3 billion carbon dioxide business. Linda is also a leader in the hydrogen supply chain, producing and supplying hydrogen to enable cleaner energy," unquote. Simply put, this is a remarkable business that has multiple ways in which to win and make a lot of money for shareholders. Taking CFRA's number as our near-term base case, Linda should easily be able to increase the dividend at a 10% plus annualized rate for at least the next few years. That may very well settle into a high single-digit range thereafter. Either way, you're looking at a high-grade compounding machine here, and you're starting off with a respectable yield while the machine makes you money. Moving over to the balance sheet, Linda has an extremely strong financial position. The long-term debt-to-equity ratio is 0.25, while the interest coverage ratio is north of 67. Profitability is mixed, but the metrics have been sharply and steadily improving since fiscal year 2019 after the merger finalized. Over the last 5 years, the firm has averaged annual net margin of 13% and annual return on equity of 11.8%. It's really hard to find anything to dislike here, and the business does benefit from durable competitive advantages that include global economies of scale, high barriers to entry, switching costs, a global oligopoly, and long-term contracts backed by fixed infrastructure. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. The industry's oligopoly does limit competition, however. The business has cyclic traits, and a recession, which would reduce manufacturing activity, would almost certainly adversely affect Linda. Linda's involvement in large-scale energy projects around the world adds uncertainty from the fast-evolving nature of energy. Input costs can be volatile, but pass-through clauses mitigate this issue. Less than half of the company's sales come from the Americas, which exposes the business to currency and geopolitical risks. I see these risks as being really quite acceptable for such a high-quality business. That's especially after considering the valuation of the business, which looks decently attractive right now. The forward PE ratio is 27.5. That's based on adjusted EPS guidance for fiscal year 2022. I'd like to see it lower, sure, but it's not unreasonable at all for the growth profile. We can also see that the price to cash flow ratio of 16.8 is modestly lower than its own 5-year average of 17.3, and the yield, as noted earlier, is just about in line with its own 5-year average. I valued shares using a 2-stage dividend discount model analysis. I factored in a 10% discount rate, a 12% dividend growth rate for the next 10 years, and a long-term dividend growth rate of 8%. The 2-stage model is designed to account for Linda's post-merger acceleration in bottom line and dividend growth, which should moderate over time, the initial stage of growth is not far off from Linda's recent dividend raises. It's also right in line with CFRA's near-term earnings per share growth projection for the firm, and that projection is backed by Linda's own near-term EPS growth guidance. The payout ratio remains low, giving further flexibility to the dividend. The long-term dividend growth rate I used is reserved for very high-quality businesses like Linda. It assumes a normalization of overall growth down the road, which I believe is likely. The dividend discount model analysis gives me a fair value of $354.36. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates LIN as a 3-star stock with a fair value estimate of $347. CFRA rates LIN as a 4-star buy with a 12-month target price of $352. We have a super tight consensus here, which is encouraging. Now, this stock jumped by almost 10% while I was in the middle of compiling data and putting this report together, and that's untimely. Still, averaging the three numbers out gives us a final valuation of $351.12, which would indicate the stock is possibly 7% undervalued. Here's the bottom line, guys. Linda PLC is a very high quality business with many levers to pull in order to make money. Surprisingly, it's only getting better, with improving profitability and accelerating growth being prime indicators of that. The stock did run up in the middle of my work, but it's a terrific business to own for the long haul. With a market-like yield, an accelerating dividend growth rate, a low payout ratio, nearly 30 consecutive years of dividend increases, and the potential that shares are 7% undervalued, long-term dividend growth investors looking for a world-class compounder should definitely have this dividend aristocrat on their radar. And now for a special news announcement. Lockheed Martin Corp, stock ticker LMT, is about to make a lot of money. Canada has announced that it plans to buy 88 F-35 jets in an order that'll be worth more than $14 billion. The world's largest defense contractor just keeps getting bigger. This was one of my top 5 stocks for 2022. Although we flipped the calendar, this is still one of my top ideas for long-term dividend growth investors. If you don't yet have any Lockheed Martin in your portfolio, it'd be a good time to consider changing that before this thing takes off from the runway. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.